This video is sponsored by Moomoo. Use my link down below or go to StatsSurfest.com/Moomoo. Deposit at least $100, and just like that, you get up to 5 free shares of stock, each up to $2,500. Again, 5 free shares of stock, each up to $2,500. Get your free money. It helps out the channel as well. And with that being said, let's get into the video. So check it out, guys. You saw the title of the video today. We got to break down 3 quote-unquote safe dividend stocks that I'm looking to buy right now. And number one, you guys can see it right here on the screen. It is good old Johnson & Johnson. And no, these stocks aren't going to be the sexiest stocks out there, the most awesome to track, the biggest, highest growth stocks out there. They're dividend stocks, for Pete's sake, guys, and they're safe dividend stocks for that matter, guys. So we got to break down some charts in this video, and of course, we're going to dive into some financials, some numbers, and go over whether or not these companies, the dividends that these companies are paying, whether or not they're safe. So let's get into it. So first and foremost, when it comes to Johnson & Johnson, on this chart, it is down about 6.5%. And I don't want to focus too much on the charts in this video because the video will end up being very long. But overall, it is down a little bit over the past couple of weeks, but it is still overall in an uptrend. You guys can clearly see that here on the 4-hour chart. Over the past couple of months, this stock has been uptrending. So let's dive into my Safari tab very quickly. Here we go, guys. You all can see Johnson & Johnson is trading at $174 a share right now when I'm filming this video. The PE ratio is right around a 23, which, let's be honest here, that is a little bit high for Johnson & Johnson. So right off the bat, when I'm looking at that PE, I'm like, this is a little bit high. But the yield, the dividend, is 2.5%, so not too bad, right? So you got to look at it like, okay, we're in this environment right now. Interest rates are going up. People are going into safer investments. They want that dividend yield that can kind of mimic a bond, because let's be honest here, bonds are not good, at least in my opinion. They're not worthwhile right now with the amount of inflation we have. So for me, being a younger person, and obviously if you're watching this video, maybe you're later on in life, that's a little bit different. But in my scenario, for me, it doesn't make sense to buy bonds. I'd rather take a little bit extra risk, buy a stock, and get that dividend yield and have that potential upside in price appreciation. That is what I'm looking at here, guys. So Johnson & Johnson, 2.5% dividend, P ratio 23. It's a little bit high. I would rather see it 16 to 18 range. And the market cap is $460 billion. So when you're looking at dividend stocks, guys, you have to ask yourself, is the dividend sustainable? Is this a one-off dividend where it's going to go to zero in a couple of years, or is it sustainable? So let's go into these numbers here, into the financials. Yes, you got to break down financials, guys, when you're looking at stocks. We can see here total revenue. Okay, it's been growing over the past, 10, 20 years as expected for a company like Johnson & Johnson. And when it comes to their net income, that has also been growing. You guys can see here net income over time has been growing from, $9 billion to $13 billion. That was about 8-10 years ago. And now it's roughly $21 billion, or it was roughly $21 billion for 2021. Now, when you're looking at dividends, you want to see the EPS for the company, or of the company, for the trailing 12 months, which in this case is $7.42, and you want to see how much they're paying in dividend. This is also called the payout ratio, the amount of dividends they're paying compared to the EPS. So in this case, $4.52 is what they're paying yearly in dividends per share you own, and the EPS per share, earnings per share, is $7.42. So that $4.52 dividend could easily be covered by the earnings from the trailing 12 months. So that's good. That's a plus here for Johnson & Johnson. Now you have to go a step further and look at the cash flow statement. Let's pull up the cash flow statement. You guys can see here free cash flow trailing 12 months for J&J is $19.7 billion, which is good. Now we want to see how much was paid in dividends for, the year, or the trailing 12 months, which in this case, let's see here, Cash dividends paid $11.16 billion. They've paid over $11 billion in cash dividends, and again, the free cash flow is $19.7 billion. So they can clearly cover their dividends with the free cash flow. It's no problem. So it's not a problem for J&J to be paying these dividends. So for me, it's safe. I like this stock for a dividend payer. Let's go to stock number 2. Stock number 2 is Procter & Gamble, and this is probably a little bit lofty in terms of valuation. The PE ratio is a 25. Like I said with J&J, I would want to see Procter & Gamble 16, 15 PE, even lower than that. But let's be realistic here. 15 to 18 is a pretty solid range for Procter & Gamble. So let's see. Right now, their market cap is $344 billion, and they're paying about a 2.5% dividend yield, so pretty much the same as Johnson & Johnson. And in terms of EPS for the trailing 12 months, Procter & Gamble is right around $5.75, and their dividend is $3.65 per share you own per year. So clearly, in terms of earnings, Procter & Gamble can cover that dividend, no problem. And if we pull up the financials here, give me a second, guys. This is growing revenues over time, obviously, but the rate at which it's growing is slowing down. In fact, look at these numbers, guys. In 2000, and this is interesting here. This is very interesting. You can see their revenues increased from 06, 07, 08, 09 throughout the Great Recession, and then they ended up dumping here in 2016, 17, 18, right? From 83 million, I think the peak quarter or peak year was 2008. They did $83 billion in revenue, and then in 2016 they did $65 billion. So their revenue's all over the place. But generally speaking, over time, it's gone up, obviously, and they're a very profitable company. You guys can see the net income over time has gone up. So let's see right now the cash flow statement. Can they cover their dividend with the free cash flow? Let's see here. Financing cash flow, cash dividends paid. In the last 12 months, trailing 12 months, $8.7 billion have been paid in dividends, and the free cash flow, $13.9 billion. All right, so they can cover that. It's not a problem, and they're still free cash flow positive. Same with Johnson & Johnson, which is good. A bad thing would be if these companies were free cash flow negative, and, let's say they're losing money, but they're borrowing money to pay the dividend. That would not be good whatsoever. One of these companies is ZIM. Let's actually look into this one. This should be fun. This is not a stock for this video, but kind of going on a side tangent here. ZIM, I want to see their cash flow statement. They're positive free cash flow, but can you see how quick or how massively this spiked up in just the past year or two? In 2019, free cash flow was $350 million. And now, in 2021, it was $5 billion. So this is a clear influx of, business in the short term, and I don't think it's going to last long term. And let's see the financing cash flow. Their dividends, cash dividends paid, trailing 12 months, $500 million. The free cash flow is obviously well above that. So in the short term, I guess they can sustain this dividend. But if you compare the dividend they're paying now, which is $530 million for the trailing 12 months, compared to the free cash flow from just 3-4 years ago, that free cash flow is way under what they're paying right now in dividends. So in other words, if this business comes back to normal in a couple of years, which I think it will, that free cash flow comes down a lot, then they're not going to have enough money, or it's not going to make sense for them to be paying this massive dividend. And, that's just my thoughts on ZIM. And again, that's not a stock for this video, but I figured we might as well talk about it. So the next one, and I know I didn't cover Procter & Gamble's chart, the stock chart, but it's all good. I don't want this video to be too long. The next one here is A.O. Smith, which shout out to Josh Brown. What's his podcast called? Him and Michael, right? Michael and Ben. Their podcast is called Compound and Friends, I think. I watch it all the time. He brought this stock to my attention months ago, A.O. Smith. It's one of these low-key companies that not many people know, but if you go down and look at your heat pump, electric, water heaters, boilers, tanks, they make all these. They make a lot of these products in North America, China, Europe, India, and this is a great business if we're heading into a deep recession, and the stock price has come down a good chunk. I think it's down 30% recently over the past couple of months. So now it could be a decent entry. We have market cap right around $9.5 billion. So again, smaller company here. P ratio at a 19. Okay. I mean, it'd be nice if that came lower, but it has come down a lot over the past couple months. Like I said, the stock price is down 30%, 40% roughly. Let me double check that actually. I don't want to just be throwing numbers out. A.O. Smith, all-time high, or the recent high, was $86. Now it's at $59.60. Yeah, it's down about 30%. So they're down a good chunk. EPS right now, trailing 12 months, $3.18, which could easily cover the dividend they paid, $1.12, and the dividend's right now 1.8%. And popping over here to the financials, guys, you can see they've clearly been growing revenue over the past couple of years. Nothing crazy. It's not growing at a massive rate, but it is growing nonetheless year over year revenue. And let's see here, the net income. Net income is also nicely growing over time, which is something we want to see when we're looking at a business, right? So we talked about how the EPS could clearly cover the dividend, no problem. Their payout ratio is like a 30%, which is very low. Let's see how their free cash flow is looking. So free cash flow has been growing over the past 5-6 years, which is solid. And let's look at their financing cash flow. Cash flow from continuing financial operations or activities. I don't know how Yahoo Finance puts it here, but let's see here. Cash dividends paid $170 million, guys, trailing 12 months. That could easily be covered by the free cash flow. So not too shabby, guys. And that's it pretty much for this video. I don't want it to be too long. I wanted to make this video, honestly, so I can show you how, not necessarily to tell you what to buy right now, because that's not what this is, but I wanted to show you how to analyze dividends on kind of a really basic level, right? Look at the financials, look at net income, free cash flow, look at the dividends paid, and just be honest with yourself, because a lot of these businesses out there, they take out debt to pay a very high dividend. They're unprofitable. They're paying this dividend just to sucker a lot of newbies in. And listen, think about it, guys. If a company's paying a 20% dividend, right, and let's say the stock's price is $100, it pays a 20% dividend. Sure, it could pay this 20% dividend, which is nice. It can lure you in and you like that. But what if the stock's price went from $100 to $20? I mean, who cares about the dividend because your principal has gotten destroyed by 80%? That could happen. That could happen, and I want to make you guys aware to that. So with that being said, that's it for this video. Make sure to smash that like button if you found value, and make sure to subscribe if you haven't done so already. Let me know your thoughts down below in the comments, and feel free to join my Patreon if you want all my buy, sells, call-outs, morning videos, plus more. Now's the best time to do that, early in the month. Check it out. If you don't like it, you could always cancel. That's linked down below. And make sure to get your 5 stocks from Moomoo and your 6 stocks from Webull. Literally free money, guys. Link down below. And with that being said, cheers. Thanks for watching. I'll catch you all in the next video. Peace out.